Over the next few months, you're going to hear a lot about the interest rates decreasing or the Fed's wanting to decrease the interest rate. So it's a good thing to know what's going to happen when they decrease the interest rates. Interest rates affect everyone a little bit differently, but they do affect everyone. So it's a good thing to understand with the interest rates decreasing, how will that affect you as an individual? So we're going to touch on 5 different areas that are going to be affected most by interest rates, and then we'll touch on one at the end that's a little bit different than the rest. The Federal Reserve decreases interest rates to stimulate the economy. If we start with businesses, a lower interest rate incentivizes businesses to spend more. So they may go out and buy new equipment, or they may build a warehouse or expand production. But a lower interest rate means they pay less in interest over time, which means that they expand more. Now, as businesses expand, they also employ more people because they now need more people to produce their products, which is part number 2. Employment increases when we see a decrease in the interest rate. This is actually one big characteristic of interest rates. When we increase interest rates, we do that to decrease inflation, but that also increases unemployment over time. So when you decrease interest rates, that increases inflation and it decreases unemployment. So that's one way that it can affect you. If you're a person, you can now get a better job possibly because there's going to be more jobs. And people also get increase in wages as well. Wages typically increase when interest rates decrease. Another positive for people when interest rates decreases, now if you need a car loan or if you have a mortgage on your house, your interest rate has decreased. So it increases spending or incentivizes people to spend. People that were holding off to buy a house, they may be incentivized now to buy that house because they're going to pay less interest over time. Like we said before, businesses are expanding as interest rates decrease. So you typically see more production, you typically see more revenue, which typically means more profit. So as this occurs, if this company is on the stock market, their stock usually increases. And that's point number 4. As interest rates decrease, we usually see an increase in stock market. And you can actually see this if you go back to the last Federal Reserve meeting. We reached all-time highs in the Dow, NASDAQ, and S&P because it was good news and people are still expecting a decrease in the interest rates. Along those same lines are bonds. And during expansionary periods when interest rates are decreasing, we see more investment, and bonds are an investment. So we see more purchases of bonds. So point number 5 is bonds. And not only are we seeing more people investing in bonds, we're seeing companies create new bonds. And the price of a bond and interest rates have an inverse relationship. So these new bonds that are coming out are cheaper than the old ones that were at higher interest rates. Now, the last part's a little bit different, but it actually affects all of the things that we've spoke about already, and that's expectations. So when these things occur, people expect what we've already talked about to happen, and they react to it. And it becomes this snowball effect of expectations creating reality, and reality creating even more expectations, and the ball just keeps on rolling. So expectations affect everything we've already spoke about, and they continue to increase the expansionary period. So make sure to like and subscribe if you've watched this far. And interest rates affect all of us. So you have to know what to expect when these interest rates change, whether they decrease or whether they increase. So keep an eye out, or I guess an ear out, for what the Feds are going to say coming up and how the economy is running heading up to the Federal Reserve's meeting in June.